welcome along to the Property Academy podcast. I'm your host, Ian McKnight.
I'm Andrew Nicol.
And today on the show, we're talking about how long can I get an interest-only loan for? Now, usually when you get an interest-only loan, you are approved for a 5-year period where you're going to be, max of 5 years where you're going to be interest-only for. And then you've got to reapply for it. So we're going to talk about how long can you get it? How do you keep reapplying for it? Andrew, you've got a lot of experience doing this. How willing, let's start at the very start, how willing are banks even to give you an interest-only period at the start?
What you got to remember is that banks do make their money out of the interest that you pay on your mortgage. The principal payments is essentially savings and reducing the amount of revenue that they take in. So they are willing to do it in the right cases, but with the responsible lending code coming in, there is a lot more scrutiny that goes into an application for interest only now than there used to be. So, previously, 10 years ago, if you wanted interest only, you just fill out on the form when you send your structure into the bank and they'd document the loan that way. Nowadays, it actually has to be approved, so it's not necessarily a given. And actually, I had a question the other day from one of the clients that I work with who had been approved interest only for 3 years and was trying to decide on a fixed rate term. And so she wanted to go for a 5-year fixed interest rate, wondered if that was a good idea. Now, the problem is if in 3 years she asks for a renewal and the bank says, no, we're not prepared to do that, then she's got 2 years remaining on her fixed term, but she reverts to principal and interest. So if she wants to refinance it and there's a break fee associated with moving that loan, she either has to pay principal for 2 years or pay a break fee. So neither of which is a good outcome. So you've kind of got to take the maximum term that a bank will give you at the start and then pick your interest rate to kind of suit within that. So my recommendation would normally be, okay, we'll go for the longest period possible, 5 years, which is generally speaking what a bank will give you. And then maybe fix for, you might fix for 1 year, and then you might fix for 3 years so that it all renews at the same time.
And actually, just to jump back a little bit and talk about the difference this makes to your cash flow as a property investor, let's say you've got a $600K mortgage and your interest rate's 2.5%. Now, there is about a $260 difference between being on interest only and being on principal and interest. So your repayments for interest only would be about $290 per week on that $600K loan. On P&I, you're at about $550 per week. Now, most properties, vast majority out there, are not going to be cash flow positive and are going to require about a $200, perhaps even more, $220 top up from the investor in order for that property to not go into overdraft. So it is very important. And a lot of people, again, if you're leveraging up because you're early in your investing stage, then certainly an interest only becomes very, very important. Now, I was talking as well to some economists, our friends at CoreLogic, after they were talking about the fact that all banks test your lending as if you were on principal and interest anyway. So you go, you apply for, say, a 30-year loan, and let's say that you applied for a 5-year interest-only period. Well, the bank is actually not going to test you P&I on 30 years. They're going to test you on 25 years. So once you've had your interest-only period, are you still able to make the repayments that a 25-year P&I loan, principal and interest loan, would need? Because they want to make sure that you've got the money in order to be able to do that. Now, one question they had for me when we were discussing this is, well, how long can you keep extending that for? So one thing that investors come up against is if you get to the end of your 5-year interest-only period and you want to extend that further, you want another 5 years on interest only, well, the bank is now going to test you on whether you could afford P&I payments on a 20-year loan, so the end of that 5-year period. Now, if you're tight on servicing, that might become a bit of an issue. So what you might do is then take that loan and apply to extend the term further. So instead of 25 years, apply for it to be 30 years, and then in that case, take the 5-year interest-only period again. Now, the question that they had, the guys from the NZ Property Markets podcast had for me was, well, how long can you keep doing this for? Is it kind of 35 years, because at 35, add 30 years on, which is your mortgage term, you're 65 and you're probably no longer working. What's the oldest person you've had a 30-year term approved for?
So this is where it comes down to kind of bank discretion, and I don't think there's actual written policy there, but the bank does have to, under responsible lending, consider the shelf life of someone in terms of their working career. So let's say, for example, you're 50 and you're applying for a 30-year loan. They might do that because with some of the banks you have to explain how the investment, because that's what it's generally for, is going to be paid off. And sale of that asset is a completely legitimate answer for that under the responsible lending. If, however, they're 62, then you might find that they are going to scrutinise it a lot more doing a 30-year interest-only 30-year term. So it does come down to discretion a little bit. Where I've seen older people get longer periods is maybe if there's a large age gap between the two spouses. So that's potentially a case. Non-bank lenders who don't have to adhere to the responsible lending, which I know we're going to go into. But actually, the way that I found this to work easiest is not to actually reapply with the bank. So, for example, BNZ were really harsh, i.e. not really approving interest-only extensions, and I think that's still the case. So if you take your initial, let's say your owner-occupied house is with BNZ and you borrow 100% with BNZ against a rental property, then when you come up for renewal, generally speaking, based on 5% growth per annum, your house is now at 80%, your investment property is now at 80% if you were to move it to another bank, so you can move under the dollar for dollar refinance. So for a lot of investors that I've worked with, what they've done is they'll take out that initial loan with BNZ, they'll go 5 years interest only. In 5 years, they'll make sure that their interest rate, as I mentioned before, times with the interest only renewal, then they'll move that mortgage to Westpac. They do that, park that there, go 5 years interest only, and then after that they might go to Westpac and say, hey, you're willing to do this. If they're not, move it to another bank. As time goes on, obviously rents go up. And so you can probably at some stage afford to pay down some principal. And there's nothing wrong with paying down principal. It just does affect your cash flow. So, but if you can afford to do it, then I guess, it's not a big deal.
Now, let me ask you this. What's the longest period that you've seen an investor have interest only for? Are we talking 15 years? Are we talking 30 years? What's the longest you've seen?
30 years. So Westpac used to approve interest only for 30 years by default. So you could actually apply for a 30-year interest only loan. They don't do that anymore. Responsible lending changed that. So now it is always just 5 years at a time. I'd say for the vast majority of my investors, they're paying interest only and they always will. And I guess I've been very active in this market for 15 years. I very seldom have had an issue having an interest only renewal, so long as there's reasonable reasons for that to happen. So it often talks about how he's heard me on the phone to banks, barking at them saying, well, it's irresponsible of you to put this person on principal and interest, saying that it's a servicing thing and you're going to make them negatively geared. They've got a personal mortgage, there's interest deductibility, back when there was for an existing property. You need to consider all these things. And generally speaking, I got my way.
And is it simply about really pushing for it, asking for it, giving some valid reasons and pushing back to say, hey, there are some reasons, Mr. Person sitting on the other end of the phone?
I know there's lots of times where I would ring the investor's accountant, ask them to send a letter saying this person has interest that they pay on a property, i.e. their own home, which is not tax deductible. It's inappropriate for them to pay down their investment mortgage before that's paid off. My recommendation is they continue to pay interest only on that, and then I'll supply that to the bank.
Yes.
Another thing that I'll do is for some investors, what I've done is worked out what the principal payments work out to be on a particular investment loan. So say it was $150 a week. Then I would say, okay, well, we'll compromise and we'll pay that $150 extra off the personal mortgage. In a lot of cases, if people have had a personal mortgage for a long period of time, they're already paying more than they need to anyway. And so the bank has a shortened term on one and the longer term, i.e. interest interest only on another, and so it works out the same.
Are they enforcing that when you're making that compromise?
Well, no, generally speaking, they're already doing it. So most people are paying more than they have to on their personal mortgage.
And let me ask you this as well. What proportion of your properties, I know you're in the commercial division for a lot of your investments as opposed to, standard residential like most people listening to the show would be, but what proportion of your properties would you say are on interest only as opposed to P&I?
So it's funny. I always said I'd never pay any of my principal off, and I've stood to that for years. Turns out 4 of my loans are actually on principal and interest, and I didn't even realise. So recently when I was doing a review, I noticed that a few of my loans had ticked onto principal and interest, and because I'd moved house, I think I hadn't received some of the correspondence around that. And actually, I've owned them for so long now that the rent is more than enough to cover all costs and principal, so I'm probably not even going to bother to change that. But I would say that the vast majority is interest only, and I've never had a trouble renewing it.
And so when investors are putting together their cash flow forecasts for their investment properties, how long would you feel comfortable them assuming that they will get interest only for? Is it 5, 10, 15, 50 years?
I think 15 years is kind of the budget that I would normally work towards, and I haven't had anyone have problems renewing that unless they'd done something like missed mortgage payments, they'd got some bad credit, done something stupid.
And it's quite interesting as well. We're going to have the General Manager for New Zealand of Resimac on the show shortly. Luke Jackson's his name. I was at an event, Juno Investing event not long ago, and he said, well, at the moment, we're approving 20-year interest-only loans. So certainly we'll get him on the show to get some more details about that. But it does appear that there are products out there where investors who are looking for that sort of comfort may be able to get that. But again, we're going to get more into detail about that and run them past the hard questions.
Yeah, and that's sometimes you just have to pay a little bit extra to have that certainty and have that flexibility. So going to a non-bank lender, sometimes called finance companies, which have that stigma of having really high interest rates, but second-tier lenders are just non-bank lenders nowadays. They're the ones that might charge you a % extra, but if they'll lock you in for 20 years interest only, then great.
The other thing that a lot of investors ask is, well, how do you make money, with property if you're not paying down debt?
Yeah, so I get this time and time again through capital growth. Now, quite simply, if you were just relying on those principal payments, it's basically savings. Only you're getting a 2.25% interest rate rather than a 1.25% or 1% interest rate, whatever the savings rate is at the moment. So realistically, that extra payment that you're paying off, or that extra equity that you've got later on, it's your money. It's not. It's only growth really that's adding to the benefit of property.
That's definitely it. The other ways as well is any rental cash flow that you're saving over that
Yes.
time that builds up. And eventually, once your rent increases to the point where it does cover P&I, if you're investing over that very long period, then certainly paying down debt at that point is the equivalent. But really, that's just a trade-off between cash flow and paying off debt at that point, because really that's just savings as well.
And I always say to investors, and I remember I was having this conversation with someone last week who it is very, very hard for them, just based on what they've been taught by their parents, to get their head around not paying down debt. Now, when I did a couple of graphs and I showed them that, say, a property over 15 years might cost them $50 a week, well, it's really easy to work out if that property costs $200 per week on principal and interest, are you better off having one property that you're paying off $150 a week, or are you better off having 4 properties? And the 4 properties wins by a landslide.
Especially as assuming if you're going to get that capital growth over time. So key takeaways from this show, I guess, is don't be afraid to ask for interest only. You can get it. It is there. And I know a lot of investors worry, I'm only going to be able to get that for 5 years. You can always reapply to extend. And if your mortgage broker is worth their salt, generally this is very achievable for people of normal credit who are out there making their payments and not falling behind or getting bad credit.
And I think it's really important to use a mortgage broker. I've harped on about that for a long time.
For 615 episodes.
Yeah, but because of the fact that, if you go to your bank and they're just not in the market for renewing interest only, you want to be able to go to someone that then's going to be able to say, well, that's okay. I'd more than happy take them somewhere else and get paid for rewriting that mortgage. Banks suddenly realise that you've got other opportunities if a broker's representing you.
Fantastic. Let's wrap it up there, but please don't forget to rate, review and subscribe to the show. It really does help us get the message out to more people. And hey, if you want to come along to those dinners with Andrew and I, we're coming to Christchurch, we're coming to Queenstown, Wellington and Auckland. We're taking 10 of you out, plus your partners as well. How do you enter that draw? Because we are about to draw that in the next couple of days. Step 1. Don't forget to rate, review, and subscribe to the Property Academy podcast. Really helps us get the message out to more people. Follow us on Instagram. We are at @opus_partners. And don't forget to share something to your story or to your feed, something along those lines. And then screenshot it, send it to podcast@opuspartners.co.nz. We'll put you in the draw. And don't forget to include which city you're in. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nichols.
I'm going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market.